Not to repeat, so I think reading a bit your questions, the question is not so much about the size of non-banking financial intermediation, because it's very, very wide. It casts trillions of dollars, all kinds of instruments. I think what you seem to be interested in is funds that are called private credit funds, which are entities that lend directly to companies in lieu of banks. So it used to be banks lending to companies, and now we have some vehicles that do the jobs of banks. And we see also some institutional investors doing it directly. So we see an insurance company who may make a loan. We may see a Canadian pension fund just lending money to Thames Water, for example. So that's a changing landscape. Thames Water used to go to the British banks and now can go to a Canadian pension fund for a loan. So I guess this is what you are thinking about. And so that is much smaller, probably around $2 trillion of assets under management, the loan portfolio. It's important to think as well with this figure that most of it is the US. It's like 3/4 of that number is the US. The US is really where they're larger in size, but this is also where the trend started, and this is really where this is most practiced. As was just said, probably the reason the UK is the second largest is because the UK legal system and the professionals in London are very similar to the ones in New York, and so it's very easy for an American corporation. The largest lender, direct lender in the world is called Ares, and Ares is in the US, has opened an office in London. The head of Ares London is Blair Jacobson. He's a guy from Chicago who has lived and grown in the US, just comes here. It's very natural and very easy, and so they can redeploy the same strategies as in the US here in London. So it's probably why. Now, we need to also, some of your questions were around, do they really help the economy and things like that. Then it's important to make a sort of distinction between different players. So there is this world of private market funds or private capital funds. So Ares is one player. You have probably heard about Blackstone, Carlyle, all these big names. So these are all large private capital firms, and they provide loans. You can call Blackstone to get a loan. You can call KKR, etc., to obtain a loan. And so these firms do a bit of everything. And it's important to distinguish between the ones that are called venture capital and growth capital, because these firms inject capital into companies. They take a minority stake in company and inject capital in the company. So universally, these firms are the darlings of policymakers all around the world. People just don't have enough. They want to know how to have more venture capital in the UK. They want to know how to do a Silicon Valley in France. It's always these themes that are there on the table. They are the darlings. The other, about half of the market, is what we call leverage buyout, which is not a very fancy name. People don't quite like to be called leverage buyout, even though this is exactly what they are doing. They prefer to go by private equity because in the hope of being mixed with venture capital, who are the nice guys. So leverage buyouts are the infamous ones. They are the ones who are behind Boots, behind Toys R Us, behind the collapse of some care homes in the UK, and so on and so forth, and Thames Water. So these are the relatively infamous ones. And private credit, who makes these loans to companies, most of them, 2/3 or so, are made for these leverage buyouts. So if you are going to take over Boots or Pizza Express, etc. in the UK, then most likely the provider of the debt to take over this target is going to be provided by a private credit fund. So for the picture, what you seem to be interested in is this lending to companies. There is some lending that would go to the local entrepreneur who wants to borrow money, and then maybe the bank doesn't give a loan and they go to a Blackstone or a KKR, but that's not really the typical transaction. The typical transaction is, I'm KKR, I want to take over Boots, I'm going to finance this with 3/4 of debt or 2/3 of debt, and I'm going to go to CVC or Ares to obtain a loan in order to take over that company. And the controversy comes from the fact that this loan that they contract in order to take control of a company gets shuffled into the company's balance sheet, right? So all the controversy is you have Boots who didn't ask for anything. Somebody's taking control of Boots and saying, by the way, all the debt I had to take you over is on you to repay, right? And so this is where the controversies come from. So these questions about, the usefulness of private credit and the like, I think needs to be also judged in the light of these loans are not going to the local restaurant or the local entrepreneur. Some do. And they are expanding in that area because as they are doing more and more lending, of course, they're expanding on all kinds of areas. And there will be some venture capital, the early stage companies that will get a loan from a small private credit fund. But as of now, it's not really the majority.
Just to be really clear then, when you're investing in the big leverage buyouts, in effect, this is not an investment in future growth. This is actually almost the opposite, because you're reducing the ability of the company itself to invest because it's got massive debt pile within it.
You could put it this way. These are professionals of running companies, and so they may also bring a lot of improvements to the company, potentially. But yes, the distinction I often make is between the primary transaction and the secondary transaction. So often, if you hear an entity like, KKR, it can be any one of them, they will say, or the BVCA is very good at playing with language. Like, we have invested in this many dollars in the UK businesses. What you did is that you bought these businesses from someone else, and so it's just a transfer of ownership. This is what it has cost you to buy all these UK businesses. It's not an injection of cash into the UK businesses. The other thing related to what you said about who finances it, behind it is it used to be mostly pension funds and sovereign wealth funds. The growth of private credit is fueled a lot by insurance companies. None of your questions touched on that, but I think it's a big point that insurance companies seems to be doing regulatory arbitrage with private credit funds. They are allowed to leverage 10 times $1 invested in a private credit fund, which is a fairly risky type of investment to begin with, and allowing insurance companies to have such a high leverage on something already levered is quite a wild move. So insurance companies are the main providers of capital to private debt funds. The sovereign wealth funds and pension funds are still a big contributor to private equity funds, and they also contribute a lot to private credit funds. And now the new the new boy in the street is the retail investors who are investing in both. We see now retail investors giving money to private credit and to private equity funds. But from a macro perspective, you can think of like these pension funds of the world giving both the equity and the debt in these leveraged buyouts, which means that on net, they're just holding an unlevered asset. They're just holding the asset, but it has just been sliced in many pieces, and all kinds of people are financing all kinds of pieces, including banks, giving all kinds of credit lines, etc., in these transactions, giving loans to the private credit funds who then lever with bank extra in order to lend. The private equity funds borrows also a bit from the bank with credit lines to delay capital calls, etc. So the banks are playing there everywhere. All kinds of financial intermediaries are there. Companies get sliced into many pieces and the like. It's a massive mess. But at the end of the day, from a global perspective, you just have mostly pension funds holding companies like it used to be.
I'd like to ask where, in all of that, regulation actually stands. What are your reflections on the current regulation of private markets? And do you consider that private markets should be subject to more oversight, ranging from greater transparency, perhaps, or disclosure to prudential regulation?
So most of the questions that the committee seemed to be worried about was around whether there is a systemic risk posed by these people who just act like banks but are not regulated like banks, right? These private credit funds. And perhaps more broadly, should we be worried about private equity being so big, controlling so many UK companies and the like? So I don't think there is any systemic risk to be worried about. In terms of information, investors are receiving quite a lot of information. The broad public does not. But Is that really a loss? I think so, but this could be debated. In the UK, all else equal, the public could have information to companies compared to the US, because the UK at the Chamber of Commerce has the accounts of about any companies in the UK, including privately held ones. So for example, a study I did of private equity running care homes in the UK, I had access to all the balance sheets of all the care homes in the UK, be them private equity owned or not. In the US, this wouldn't have been the case. So there is quite a lot of information out there. However, it took us a lot of time because they use all kinds of structures and vehicles all over the place, and to consolidate all the information is a huge amount of work. So there could be some efforts in terms of making the information more standard, easier to aggregate, and so on, even for the investors, because the investors receive thousands of pages of PDF, but it's very hard for them to aggregate and have an overview of what's going on, where the money goes. And some companies will not measure leverage the same way as another one. They will not report performance the same way. They're not going to do valuation the same way. So there is quite a mess on the information being provided, but I don't think there is a systemic risk that you need to regulate private credit like you would with banks. But there is certainly an effort that could be made on data to standardize it and clean it. I've long argued that we need a lot of intervention in terms of investor protection. So it has been fallen on deaf ears mostly. The US at one point with the Obama administration, then with the Biden administration, the SEC did make some efforts in terms of investor protection in private equity and private credit, but very timid. Recently, the SEC was sued by the industry for trespassing or like overreaching, and successfully. So then the SEC had to stay away. In the UK, I've had many conversations with the FCA, who have basically always told me that they don't really care about private markets, and unless the Parliament would ask them, they would not really act. I always thought it was quite an emergency, and now with the retail in that space, I think it's a drama not to have strong investor protection. We have really relatively affluent people. It's not really, the people on minimal wage, but they invest in private credit funds without having an idea about where this money goes, all the layers of leverage that are put on it. They do not understand the legal contracts that are behind it. They're extremely complex. And so I think that's a matter of emergency. And the insurance companies playing tricks. But the systemic risk of the banks or the private markets, I don't really see it.
The Bank of England, of course, is worried, or says it's worried anyway, about the increase in private markets. And it worries partly because of the unclear interconnectedness of the various sources. Do you share that worry?
I just wanted to add to what my colleague was saying. I think I agree that so from a systemic risk point of view, there is less of a concern, but from a regulator's point of view, and Bank of England has already done quite a lot of work on this. I appreciate that, but it might be worth looking into this in more detail, understanding the interconnectedness, not of just public markets, so the bank market and private markets, but also interconnectedness between different types of investors and also the blurring of capital. So we're seeing sort of interconnection and blurring not just between the markets, but also between different types of investors. Because, for example, post-COVID, we're seeing increasingly this trend of hybrid funds, which are funds that invest both in equity and debt. Before COVID, there was a clear distinction between equity funds and debt funds, and with COVID, we saw it posed an exogenous risk, which wasn't really factored in the rationale of the fundraising of the funds. And so now some of the more sophisticated funds, the bigger players, are in a better position to come up with structures such as hybrid funds, and hybrid funds cause blurring of investors. So we will have investors that are investing both in equity and debt. There isn't really this clear distinction that used to be before COVID between equity and debt investors, but we're also seeing this increased blurring between capital, so equity capital and debt capital, and I think this different interconnections we're seeing sort of convergence of markets, investors, and capital, And this is something relatively new. It didn't used to exist before COVID. It wasn't really there after the global financial crisis. So from a regulator's point of view, while I appreciate that they're doing a lot of work on this, it might be worth taking a more detailed look into the interconnectedness. And if I might add, this interconnectedness is relevant not just for the UK market, this is global. US funds, when they invest in the UK, there's a lot of cross-border element here. And from UK's bank point of view, from their point of view, I think they're also thinking when they originate the debt and they sort of sell this debt to the secondary market, liquid market, are they going to be able to offload this debt to, for example, US funds? Because will US investors be interested in this? And there is another layer of interconnection here. So it's not just the markets, I think it's markets, investors, and capital, and there is this great blurring phenomenon, and I think this blurring presents lots of possibilities, not just for UK. I think it presents global momentous possibilities, but it also raises new questions. And from my point of view, those questions are not necessarily regulatory. From my point of view, those questions are more about what are the implications of the blurring of capital, for example, when we look at our legal framework such as corporate law, corporate governance, insolvency law, because our law has quite a distinct characterization of what is equity and debt, and my colleague was mentioning investor protection and I would also add investor accountability, because if the investor does something wrong, they must be held accountable. But we have quite a different sort of equity is equity, debt is debt, and this was done for understandable reasons, including when the Companies Act was introduced at the time. The market was very different. We didn't really have this type of advanced blurring. So I see this as sort of as a bigger concern as opposed to the regulation of funds.
I just wanted to pick up on the issue of systemic risk. I was rather surprised by the confidence that both of you display that systemic risk is not, there is not a systemic risk issue. First of all, because, as both of you have made clear, you don't know. You don't know what the connections are. The data are incredibly opaque. And in those circumstances, we literally don't know what the risks are. The other point was that, for example, in Professor Phalippou's paper, where he deals with this question, he says that the first risk is the risks are mitigated by closed-end fund structures, but closed-end funds have liquidity problems and are typically mark-to-model rather than mark-to-market, and then when the market intervenes, very strange things can happen. And it just occurred to me that the global financial crisis, the first incident was the BNP liquidity issue in February 2007 in the American markets. And that was a tiny bit of the American market, but that was the spark that lit the fire. And so how can we be as confident as you both have been that there isn't the potential spark here when we don't actually know what all the connections are?
Could I just clarify that? I think for me, when I talk about systemic risk, the main issue here is the interconnectedness. If we're able to identify better how the markets, investors and capital are interconnected to each other, and where is the risk exposure?
Yes, but there's an invisible connection. It's called confidence. And if there is a loss of confidence, there may be no formal transactional relationship between two financial institutions, but one can bring the other down if there's a loss of confidence.
So from my point of view, I'm not saying that there isn't systemic risk issue. What I'm trying to say is that this new angle of interconnectedness is something that the regulators should take a look at from a systemic risk point of view, because this angle brings new opportunities, but it also raises new questions. And those questions, from my point of view, many of those questions are more on potential reforms in the corporate law framework, for example, explaining how to deal with capital that's not equity and not debt, and how to hold an investor accountable or protect an investor in those situations. So maybe that should be the first step in the direction of sort of, us better understanding what's happening there.
So thank you for raising the point. Economists tend to be very simplistic, so maybe like we're missing something again. But let's try to unpack that. So when there is and there has been problems, it's usually with a counterparty risk. So it's like overnight banks lend to one another all the time, and then if I'm not sure you actually have the money, you pretend you do, but I'm not sure, and then we freeze, right? So it's a Credit Suisse moment. Credit Suisse says, I have the money, nobody else believes them, we have a big problem, Bank of Switzerland have to intervene. It's usually how it happens, right? Like that there is a counterparty, we don't trust anymore, and then they freeze the lending of banks overnight, which then becomes a catastrophe because we rely on that a lot. Or you have a run on a bank like Northern Rock or things like that, or in the US with Silicon Valley recently. So let's see what the situation here is. So you have Blackstone has lent money to Thames Water. Then at one point, and this money comes from the Dutch pension funds who gave the money to Blackstone, and Blackstone gave it to Thames Water as a loan. Then we say, well, at one point there may be a loss of confidence. These Dutch pension funds want to be out of the Blackstone fund, and Blackstone will turn to them and say, no, I'm sorry, you cannot get out. Right? It's a closed-end fund, that's the rule. You cannot get out. What then? Then, yeah, the Dutch pension fund will be disappointed. Yes, they may get less return than they were hoping to get. They thought they would not have such extreme liquidity, perhaps.
They may write off the asset altogether. They write it off.
They may write it off,
yeah.
But all of
You're
this...
in real trouble.
No, then the Dutch pension fund has to email people like me, because I have some of my pension there, and others, saying, we are very sorry, but we lost your pension, right? But that's not a systemic risk in the sense of like freezing and banks saying, we are closed tomorrow, because it's not a Credit Suisse moment where over a weekend you have to find somebody credible to take over their positions. It's like the Dutch pension fund is like, oops, Yeah. And so that's why I'm talking a lot about investor protection. Right? So that we don't see the mechanism for a systemic risk because there is no counterparty. It's really the Dutch pension fund has given some money to Eris or Blackstone, who has given it to someone else. If they turn to Blackstone, it's the case right now actually. So Blackstone has the largest commercial real estate fund in the world. And they announce a valuation that nobody really believes. They think it's too high. It hasn't changed for 4 years. So everybody says, can I be out at these valuations, please? And Blackstone turns to them and says, I'm very sorry, but you won't. And then they are very disappointed. But that's, that doesn't create any problem. It's been like that for like 2 or 3 years, for example, and there hasn't been anything major happening. It's just Blackstone is gating people, saying, you don't believe my valuation. I think it's right. You don't. Well, too bad for you. The interconnectedness, that worry, like that the central bankers articulate, comes from the banks being exposed in many different ways to private equity. We can hear that worry. Also because the private equity industry, I haven't mentioned it, is quite concentrated. So you may have 20 different players, and behind them you may have 30 large limited partners. So the money going to private equity is going to be disproportionately ADIA, is going to be PIF in Saudi Arabia, CPPIB in Canada, the Dutch pension funds, etc. So there may be like 30 very large providers of capital that if all of a sudden they say, I'm sorry, you called my money, I had promised it to you, but I'm not sending it. Yeah. Then the banks who had given all kinds of loan with the idea, I have ADIA as a collateral and the like, now I don't have it, I have a problem. That's possible. Now, I'm not inside the bank, and so maybe the banks have not kept track very well of their concentration risk across all of the divisions of the banks for private equity. The ones I know working in these banks tell me they have, but I cannot check. I'm not the regulator. I don't have access to their systems. I have the feeling that the Bank of England is tracking it. But if they are not, certainly it is worth for the Bank of England asking all of the banks, add up all of your exposures directly and indirectly to private equity funds. And the most important is the underlying people, because effectively they are exposed to the Dutch pension funds, ADIA, and the like. And so it's the risk that these people do not send the money if called. And so they need to know, okay, I have I'm exposed by 2 million to ABP in the Netherlands, 1 million to CPPIB in Canada, etc., and see whether I'm diversified enough across type of institutional investors that I'm easy as a bank with all my positions in private equity. I think this is what they are doing. If not, they should certainly. But we don't have, again, this overnight lending. We don't have, if there is a liquidity issue in a closed fund, we see it with Blackstone largest real estate. It's been like that for 2 or 3 years. Nothing is happening.
Thank you.
I was just going to wonder what all of this has to do with the real economy.
Nothing at all.
You want to?
You go first, and then I'll answer.
So I understand that feeling. There is a lot of puzzle even among economists about the usefulness of finance in general, right? I often make these jokes. If you take something like Debenhams, private equity walks into Debenhams in the mid-2000s. Prior to private equity, Debenhams has no debt. They own their stores, and so the guy who owns Debenhams has the walls. They have Debenhams cash flows, and then that's it. Okay. Then private equity comes in, and they take all the walls, and then they put it in a real estate fund. Then they issue a lot of debt, and they put it in a private credit fund. Then they keep some of the equity, and they put it in a private equity fund. And these things get sliced further, etc. And then you would talk to a pension fund that would tell you, I'm extremely diversified. I have some real estate, I have some private equity, I have some private credit. I'm as diversified as it gets. Well, yeah, you just have Debenhams. And so all these finance people have sliced and diced these things with legal contracts that are super lengthy, SPVs all over the place. Jersey and Guernsey have a party, nowadays more Luxembourg. And so you have all these intermediaries feasting on drafting these contracts and the like. And I can understand that the spectator says, what are you doing this for, right? At the end of the day, on aggregate, you're still owning Debenhams, right? And if anything, you may have constrained Debenhams because of this very complex structure that meant that Debenhams couldn't move with the agility they would have had otherwise, and the like. So I understand that opinion, but it's more, I think, a philosophical thought or a policy decision rather than me as a finance guy can explain how it works. But I think it's legitimate to wonder the social usefulness of finance. On your previous points on the Bank of England, a couple of remarks maybe. The Bank of England may want to be worried as well because of a monetary policy issue. When you're a bank, you can create money. You are highly supervised by the Bank of England. If these private credit funds are bigger lenders, they don't create any money. They just take money from these pension funds and give it to someone else. And so the Bank of England is losing their tools, their monetary policy tools. They cannot control the supply of sterling pounds into the economy. So they could be worried about these things, and that would be legit. Again, the aggregation of all the bank's positions should be a worry. I think they have it under control. If not, we should help them. One example I thought could be useful is the Dutch Central Bank, which is the only central bank I know in the world that has taken it upon themselves to do investor protection with their pension funds. So the Netherlands has very large pension funds, and the central bank has taken the initiatives mid-2010, perhaps because of some of my work, to ask for better fee tracking for pension funds and releasing this information to the public, so the public knows how much is being paid to all these intermediaries for doing all these complex transactions, so that people who have their pensions there know how much of their money goes to pay for that. But that again falls under investor protection type of initiatives that a central bank like the Bank of England may want to take.
Thank you. You've both explained and told us about the dramatic growth since 2008 of private credit, and on the consequence is that the bank's role in providing credit to companies and institutions has diminished dramatically. And why are the banks happy to sit by while half of their market has disappeared? And what are the advantages that private credit has? Is it light regulation? Is it what you just described as distributed risk to in the event to holders in your pension fund. You seem to be very sanguine about the risks that are taken by pension funds. So why has the risk appetite changed? Why are the regulations changed? What are the drivers of this quite dramatic change over the last 17 years?
I think there isn't really one answer to this question, and there are certainly certain factors that have contributed to the change that we're seeing and the growth in private markets. And regulation, it might be one of those, but I think I will start with saying that in the past years, especially after the global financial crisis, we have seen an increased amount of debt, an increased amount of corporate debt. So, and this is really also to meet the demand by private equity, to scale the demand.
Side is increased.
Yes, there is the supply demand story here, and I also think that in the past years, because the interest rates were so low, the debt was quite cheap, so companies were piling quite a lot of debt, and funds were in a position to do this. So that's one factor. And then market changes and regulatory changes certainly also contributed to this. I will start with market changes because I think we could think about this question and say, well, it all started after the global financial crisis, but I would like to go actually a bit back and think about 1970s, because in 1970s, the sort of this market was the lending market. It was a very different market. We had a very sort of bilateral type of relationship between the banks and the companies, and the banks knew their customers, and there was a very relational finance element there. And then from 1970s, when the syndicated loan market had started to gather speed, we saw more sophistication on lender side, but also borrower side, and new market players have also entered sort of the marketplace at the time, including alternative finance providers. And then with 2007 and 2008 global financial crisis, obviously the regulation was introduced for understandable reasons, but it did impact banks' ability to engage in what used to be their own sort of their traditional business, which used to be relational finance, and they are no longer in a position to engage in this relational finance. So
has their risk appetite then lessened dramatically?
I do think their risk appetite has lessened quite a lot, just because of the shift of their business model. They are no longer in a position to originate this debt. Predominantly, they can't do this, to originate this debt and then keep it until debt matures, for example. And they are now in this business of originating debt and then selling it to the secondary market. So they're very much in the moving business, or they're trading the risk. And the funds are, on the other hand, they predominantly originate debt and they keep this debt until its maturity. So they're mostly in sort of, the storage business or owning the risk. But I also think, so that's another factor or growth in all this. But I also think that probably nowadays in the higher for longer interest rate environment, funds have a bit more flexibility to deploy more flexible type of strategies for companies. So there is more appetite from sort of company side to opt for this kind of private financing or non-bank financing. It also, because it provides, it's much faster to obtain it. It's speedier. It is more costly than bank financing, but at the same time, there is more flexibility for companies. And I do think that this especially plays an important role in times of economic downturn. So when COVID happened, funds were in a good position to step in and help companies to, for example, refinance. I know my colleague mentioned leveraged buyouts as one of the sort of dominant strategies, but in the past years, we're also seeing refinancing as an increasing strategy, where many companies are really struggling to service their cost of debt because the interest rates are so high, and funds are arguably in a better position to do this. So it's not just a combination of, it's not just regulation. I think there are various factors playing in here, and regulation certainly restricts banks' ability to do relational finance. They can't really do that anymore. But at the same time, we're seeing in the past 2 years an increasing appetite for banks to partner with funds to offer private credit. So one very good example of this is, I think it's quite a successful example, Citibank, which is a bank, partnered with Apollo, which is a fund. They formed a 25 billion private credit fund. It's in a form of a joint venture. So there is competition between banks and funds, but on a certain level, especially between sophisticated players, the bigger funds, they're also partnering nowadays with banks to offer this. And there are some quite successful examples and others are less successful, and that's happening.
Particular example, Citibank seems to be saying, well, we can be more innovative, charge more, apparently, what you're saying, if we do it through this joint venture. So why outsourcing that sort of business makes sense? What forces that?
I've been wondering about this question myself. I think it's a bit too early to. I'm not aware of any also empirical data that would show why, what are the profits for banks, and I think they're trying to participate in this market, but it is more costly. But at the same time, they are thinking about how to stay a bit more competitive. But I don't think I can answer this question comprehensively because it's just too early for us to know why they're.
Just before you come in, Professor Phalippou, Lord Hill, I
just want to follow on the same line, but why don't you say what you were going to say, and then I'll.
Thank you very much. One very quick one. When you say at the beginning, the banks are not providing debt anymore to the economy, right? This is your thing. Given the conversation just before about where this debt is going and what kind of things it's financing, right? So we may qualify the loss for the economy, the real sector, about the banks not providing debt to LBOs and instead private credit doing it. That said, these private credits are doing more and more type of lendings, and so they are eating more and more on the lunch of banks. So a quick advertisement. If you're interested in these questions as well, and on your way back home, I have a podcast series. The one I would recommend. The episode I recommend is the one with James Ranger, who's the head of leverage finance at Lloyd's. And I start my talk with him, as he's a good friend. So I start my talk with him with, James, I'm very worried about you. You must have nothing left to do at Lloyd's. These private credit guys are doing all of your work. So, you must be bored. And so what do you do with your days? He did pick up cycling, but nonetheless, he said that he's very busy because he's working a lot with his private credit fund. Lloyd's has now a new fund with Oaktree of this type mentioned here. And they give all kinds of credit lines and things like that to the private debt funds. But they indeed have retreated, or they lost against private credit funds on the direct lending. I did this game actually for an online course. I had professionals negotiating a debt package, and one was negotiating with James of Lloyd's and somebody called Orla Walsh, who was a private credit at Stepstone. And that happened live, where James actually priced it like Lloyd's priced it, and on my role play, on my case study, and Stepstone did. Stepstone was more expensive. James was offering a cheaper cost of debt and had less fees than Stepstone. And then the one acting as a professionals had to choose between the two. And so that's insightful because it shows very clearly then why they made that choice. They went for the private credit fund. So they are more expensive, but they went for private credit fund anyway. So what is this advantage that private credit funds have over banks? That even if the banks are still trying to lend at a lower interest rate, they are still defeated by private credit. Private credit...
Why?
Yeah, so private credit will give you what we call a single tranche. So for example, if you have 10 million of EBITDA, the bank will say, I can give you 40 million, but for the rest, I need to find some people for the rest of it, right?
Used to be called a syndication.
But, and then for the 40 million, I will even try to syndicate, and then I will probably sell some of it to someone. I don't know whom yet, and I don't know who it will end up with, right? You go to private credit, say, I'm Ares, I'm giving you 60 million today. No question asked, and it stays with me. You will not have to deal with anyone else. We are partners. I gave you the loan. If you have a problem in 3 years, you come back to me. It won't be some kind of hedge funds you don't know who ended up with your debt and you have to negotiate with. So that's massively attractive for a borrower. The other thing is that if in 3 years' time, I want to acquire a company, and James gave me the money at Lloyd's, I need to go back to James and say, I need money because I want to acquire a company. And James says, I will lend a bit too much right now, I'm not sure. It's a waste of time, and it's a bit annoying. It's not reliable. If I go to Ares always has money because they just need to call Adia and the Dutch pension fund, and they get the money I need for my add-on acquisition. So having this deep pocket, having all this money that is pre-committed by investors, means that my private credit funds will always deliver whatever cash I want. While Lloyds might or might not, who knows, maybe in 3 years, Lloyds has merged with another bank, has closed down the leveraged finance department, just like Royal Bank of Scotland did, etc. So I don't have that certainty of future lending and the like. But again, who also ends up with my debt is a big deal, because if I'm in a situation of distress and a hedge fund shows up and say, by the way, I bought all your debt on secondary market, so you're talking to me, and like I don't know who you are, and like so that's why the banks really are losing. The banks didn't really retreat from the market, so there is this idea. Certainly the capital requirements that have been put on the bank have kind of handicapped them, but not that much. They were still trying to lend, even cheaper they didn't manage to, because these guys have serious natural structural advantages over the banks. And so the banks retreated on credit lines, but now even these credit funds are raising funds to provide credit lines, and so they're even killing the banks there. So the banks keep on retreating, and then the only way then is say, okay, I'm going to have a partnership with these guys, because at Lloyds I know how to do lending, and I have a brand, so maybe if I partner with Oaktree, I can get the private credit benefits, and still I'm alive. It costs a lot more money, and so then the banks also have an additional income stream, but they are being indeed, they are shrinking, and maybe it's a natural thing, because banks are not natural long-term lenders. They have the deposits that can go out of there at any point in time. That's why they are so regulated. They are not natural long-term lenders. The natural long-term lenders is a pension fund, a sovereign wealth fund, a university endowment, and the like. So it's more.
Sorry, you say that, but the very large part of a bank book is in fact its mortgage book, which is a very long term.
They could stay mortgage providers, although now there are some institutional investors who are thinking about providing mortgages as well. We have people like Revolut who are also thinking of offering mortgages and the like, so they may be disrupted there too. But right now, on the mortgage market, because it's so small and they have these branches, maybe they'll stay there for a lot longer. But on long-term lending, like to corporate, when you have to sign 100 million, 1 billion debt, the banks are not really natural providers of that, and they are being destroyed by these private credit funds.
Mm-hmm. Lord Hill, you wanted to come in?
Yeah, well, you've just started to touch on the supplementary I wanted to ask to Lord Hollick, which is, so the banks say that the capital requirements that are put in place are reducing their ability to lend businesses, they might say in particular to smaller businesses, regional businesses, and you get that argument in the UK across Europe. What do you think about that argument?
Could I just say that there is a dramatic shift. We're speaking about sort of smaller companies here, and that sort of the funds are typically lending to smaller companies. That's the way, at least originally, we used to think about this. But the banks are now also competing with funds to provide money to multinational public companies, and not just what we used to call middle market companies. So, companies like AT&T, Air France, and Wolfspeed Incorporation, a couple of years ago, they went for private credit as opposed to bank financing. And the reason for this is because it's faster, it's speedier to go for private credit than to sort of, put the bank package together. But also because many lenders, including multinational public companies, they don't really mind having stricter sort of restrictions on the type of financing that they're going to obtain. So they're very happy to go with financial maintenance covenants in their packages. So banks now also have to deal with this. And yes, the sort of the regulatory framework essentially inhibits banks' ability to offload the debt. And if I could just add to the point that my colleague was raising on, and the point that was raised before, sort of why private credit, I don't have empirical evidence. There isn't comprehensive empirical evidence that will show why many companies are going for private credit as opposed to bank financing. I think in terms of why private credit, you could really divide this into 3 categories and say that the benefits there are, for companies, for investors, and for society. And for companies and investors, the biggest issue here is that as a company, you are not wondering whether within 6 months who's going to own your debt and whether you trust this lender. You know that from the beginning you're stuck in this relationship. And from investors' point of view as well, as a bank, when the banks originate the debt, within 6 months, typically within 6 months, they offload this debt to the secondary market. And their primary concern is what is going to happen to me if I don't manage to offload this debt, and instead of sort of hanging debt, and there will be lots of cost imposed on a bank as a result of this. So I think this sort of liquidity and long-term sort of investment, they do play quite an important role in what banks can do and what they can't do, and regulation in this regard inhibits banks' ability to do this.
Yeah, just coming back, simple question. In our last inquiry, which we just completed, which was on growth and competitiveness, secondary objective, we got evidence from the smaller banks, particularly, that the regulatory burden, the risk capital requirements, for example, made it very difficult for them to lend competitively to small house builders, but not to big house builders, because they kind of mark their own homework as to what the risks should be. And I'm certainly interested, Professor Phalippou, you've taken something from our questions. I'm certainly interested in why it is that the market has changed so much. I mean, if I think back to when I was a young man starting in business, I went to the bank took a look at you, and they decided whether or not you were, reasonable risk, and you had a relationship with the bank, and they provided that money. And what we hear from small and medium-sized enterprises is they can't get that anymore. And what I'm interested in is whether that is a regulatory problem, and you've described how the market has completely changed, and I understand the economics of that. And if I were in Lloyd's, and other podcasts are available, but I'm sure we'd love to listen to your podcast. But the fundamental point is, if we go back to the answer you gave on Debenhams, it's pretty shocking, actually. I mean, what you were saying is there are all these city lawyers and people in the city making large sums of money doing something which is not particularly useful. And what this committee is interested in is how can we actually get that money out into small businesses that are real and that are actually going to create growth and jobs and opportunities. So can you just help me by explaining, is this a regulatory problem? If it's not a regulatory problem, what do we need to do to fix it? Because there clearly is an absence of growth in the economy, and there clearly is, from any SME you talk to, they will tell you how difficult it is, never mind to get money out of the banks, just to open a bank account with the banks. So can you help me with that?
It's a tough one. The first thing, a bit naughtily to say, is that a bank will always tell you that the capital requirements are too strict, right? So by definition, because the lower they are, the more money they make, so they will always they will never argue otherwise. Nonetheless, it's true that post-2008, where, again, on my example earlier, they would have lent you 40 million and kept it on the book. Now they would lend you 40 million and then would have to find someone to pick it up, right? Which is easier if it's a big loan than if it's like a loan I made to a local business, right? So my college endowment buys some of these loans. They're not going to buy a small loan from a local company. They will buy a big one that was made. So that's true. And so the capital requirement may be revisited, but we need to be careful that the capital requirements is a safety issue. It's how much you can lever up as a bank. So you can still lend. It's just like we relax the rules about how much you can borrow in order to lend. So it's always a bit tricky to play too much with the capital requirements. But we could think of other things that are a handicap for banks, maybe the amount of regulation. I've heard that right now at ABN AMRO, it's like 50% of the workforce work in things that are related to fraud, FATCA, all kinds of work that is extremely heavy admin-wise. The amount of people in compliance in banks is shocking. There is very few people in compliance at Ares and at Blackstone and the like. So capital requirements may be one thing, but the amount of things that the banks have to do to get the clients in, it's incredible. So I would have certainly a look at all what we're asking banks to do. And we see this effect probably on the lending, like you were saying, you cannot really go that much to your local branch, probably shut down anyway, and get a loan. But my forecast is also that even on retail lending and even with mortgages and the like, Wise and Revolut, among others, are way superior propositions than any bank for any personal banking. And the puzzle to me even is how a bank is still alive in the country when you have an option like Wise and Revolut out there for personal banking. And these guys are also thinking about going towards corporate lending, like Revolut in particular. And then for the larger lending, you have private credit. So I wouldn't even be surprised if in 10 years from now, the retail will be served by things like Revolut and Wise, and companies will be serviced by an Ares, BlackRock, Blackstone, and so on. And one could try to slow down this death by having less paperwork for banks, or by increasing the paperwork for the other guys to put them at a handicap. But it's certainly a strong question. And on the what to do so the things don't go to useless things. So these lawyers in City are giving a lot of money to the UK coffer. So there is some money coming back. But there are things that policymakers around the world have thought about. There has been hearings even in here in 2008 about private equity and its usefulness, etc. Things like maybe limited the amount of debt a company can take on, limiting the tax deductibility of interest payments to avoid subsidizing the use of debt. These sorts of things might be going towards playing less with capital structures and things and focusing a bit more on businesses.
Could I just also add that, for example, types of companies that obtain private credit financing as opposed to sort of traditional bank financing, many of those companies, especially the small ones, they don't have credit rating. And this is something that banks are obviously, if you go to a bank and you don't have credit rating, you don't have sort of a history, you're going to be in a very difficult position to get any type of financing. And whereas for the funds, the companies don't have credit rating. The funds engage in doing their own evaluation of what type of company it is. It is an investment grade company. It is traditionally it's a non-investment grade, so it's sort of a lower type of sort of company. Their credit rating is not that good, but banks are not in a position to do this, and so the funds are, because of the typically illiquid nature of their investment, they're thinking about these things more carefully, and they're putting more monitoring and expertise to evaluate the smaller companies which don't really have a big track record and credit rating, whereas the banks, they just can't afford doing this because they're in the moving business. They're not in the storage business anymore. So I think I agree with what my colleague was saying, and I just wanted to follow.
I'm struck by the issue raised about the cost of compliance and the disadvantage this may create for the banks, whereas the banks have the advantage that their deposits are typically free. They don't pay interest on their deposits and so on and so forth. And that's a big advantage they would have over the various funds. And you think it'd be easier to make money if your money is free. And so are you saying that the compliance issue has, in a way, removed that advantage which the banks always had?
Yeah, it brings a huge cost, but on this, the puzzle to me is why anybody still has money in a normal UK bank. All my money is at Wise. Like right now, on a Wise deposit account, you earn 4% interest rate. 4%. You have it at HSBC savings, it's 1%. And so it's quite extraordinary that the banks still manage to get away with quite some deposit left with them. But if you look at the amounts of money that went to so-called money market funds, which is how Revolut and Wise pay you 4% on your deposit, is because your deposit go into a money market fund managed respectively for Wise by BlackRock and at JP Morgan and at Revolut by JP Morgan. They pay you 4% on your deposit because they channel your money to money market funds, and they don't have all these costs. The bank has to pay you only 1% because with the savings they do on the other 3%, because they themselves put it on money market funds to earn 4%. Then on the rest, that is to pay for all these compliance people at the bank, and still the bank is barely making money on retail. But as more and more retail are shifting money to Revolut and Wise and to money market funds, these banks are getting really squeezed. They are not. it still is, if anything, it's a puzzle. Why are people still leaving some money at HSBC and at Barclays?
Lord Bow.
There's a question to that, and then another question. Revolut has a banking license, so it is subject to the compliance, etc. So I'm curious to know why its compliance costs would be so much less than other banks.
They're going a bit slow in their compliance.
Well, exactly that. But is that not going to catch up with them? I suppose would be my question. But more importantly, you've a number of times said the real problem with the banks can't compete because they can't hold the debt on their balance sheet. The old make a loan, hold it to maturity, get it repaid, and move on model has gone. Why is that? What's driving the fact that the banks can't hold the debt to maturity, and why do they need to flip it so quickly?
They say it's capital requirements, but it's more profitable for them to be intermediaries rather than keeping it on their balance sheet. It's costly for them to have it on balance sheet. It's also a bit more risky for them, right? If you make a loan and you have 100 million on your balance sheet and it goes bankrupt, then you don't make that much money on interest, right, on this loan. So if you have like one thing to be written off, it can be a big deal for a bank. So bankers typically say it's a bit of capital requirements, but they are able to do it. It's just they prefer they can to flip it. Again, they are cheaper anyway, and despite that, they don't manage to win over private credits. I think it's for structural reasons. You could say we're going to lower your capital requirements so that you can be yet cheaper, and we can lower them even more, like if you keep it on your balance sheet. They will still not have all the advantages that the private credit has. And so you make the banks riskier in order for them to survive a little bit more, but like it's not natural for them to be there.
This comes down to if Lord Lilly was here, he'd be saying it's the problem of borrowing short and lending long. It's a fundamental issue.
Exactly.
That's my understanding as well, and I just want to say that on the one hand, sort of the fact that banks are only typically originating debt and sort of sending it to the secondary market, that's what they're doing, and they no longer typically sort of do this sort of relational finance. But on the other hand, because the secondary loan markets are so liquid nowadays, there's quite a lot of competition in the secondary market, so the funds are also there buying this debt. The competition is creating positive incentives for original lenders like banks to think more carefully about the types of packages of debt that they're originating, because if it's not a good package, the bank might not be in a position to successfully offload this debt to the secondary market. So because of this competition in the secondary market, the funds are in a better position to now say we're accepting or rejecting the type of debt that you're trying to send it to us. And that in a positive way, I think, affects the original lenders' incentives the bank's incentives to actually sort of be more involved, whether this is through covenant packages, whether this is sort of the governance side of the story before they offload this debt to the secondary market. So that's actually quite good.
So this is primarily commercial rather than regulatory. So we're talking
I call this sort of trend lender governance, where sort of the secondary market, because it's so competitive and it's in a position to say no, creates incentives for the sort of the primary market to be more involved in originating debt from a corporate governance point of view. Yeah.
Lord Kesson. Thank you. There's been much discussion about risk in this conversation so far, and my understanding from your comments is that there is no immediate prospect, as you see it, of clear and present systemic risk. But nonetheless, I'd like to ask you specifically and press you specifically on one aspect of potential systemic risk. And I'm sure you know what's coming, because thousands of gallons of ink have been spilt on the question of valuation as it applies to this asset class. Look, we've seen some illustrations across the market, haven't we, of I wouldn't say a collapse in confidence, but an erosion of confidence in the valuation process, in the valuation discipline, whether that's expressed in these eye-watering discounts to net asset value, as seen in many of the listed investment companies, or spectacular falls from grace recently in the market, attributed in some measure to valuations. And I just wonder, my questions are these: the degree to which you think over time the valuation challenges might collectively produce some kind of meaningful systemic risk across the asset class, the degree to which there seems to be the potential for some kind of collusion of interests in maintaining the current discipline across professional advisors, private equity funds, those people, the investment professionals who work in those funds, the ability to raise further capital, which is in large measure attributable to the value that is placed on those funds. So is it impenetrable as a consequence of the potential collusion of interests, or should I say alignment of interests? And if you say that, no, this is a real issue and requires meaningful intervention, what kind of intervention might that be, and from whom?
I could say that valuations and sort of price discovery mechanisms, ownership structures of assets within this non-bank finance are quite opaque. But I think my colleague would be in a better position to comment on this because it's not really my expertise area.
Thank you.
So valuations are off. We can, and in particular for some products like venture capital and real estate, we see it on secondary markets. Nobody really believes these now. They're a bit closer in LBOs and also in private credit. We think that they're off because of a massive increase in interest rates, and then we don't see much default, despite the fact that their cost of debt has doubled on average. When you have a loan from private credit, most of these loans were made, let's say, in pre-increase in interest rate. You would have the cost of loan would be 5-6% all in. Then when the interest rate goes up by 5%, the loans typically goes up by 5% because most of the time it's floating. Some people may have bought insurance, and so then they have cost of debt of 10-11% a year, which is massive. They got this massive debt and pay 11% interest on it. And the private credit who have lent say, everything is cool, we have no default, people are just paying. But we know it's not quite true. They delay some payment, there is lots of trouble, and as you say, there is a bit of a collusion of everyone saying, let's keep it let's extend and pretend, right? This is how it's called. Nonetheless, again, what this can lead to is a lot of disappointment by investors. But I do not see how that becomes a freezing of the economy like we have when banks stop wanting to lend to one another overnight and the like. I don't see a mechanism, which could be because I don't know enough, but I don't see that mechanism. Also, in 2008, when there was the big crisis, people were actually saying that we should stop market discovery. We should stop having the market trading every second and try to freeze everything and just say, okay, there's no price discovery, let's try to sort out things first. So here, in a sense, you don't have price discovery. So that makes you in a position where you won't have a sudden crisis or things like that. Again, you will have disappointed investors, but I don't see a sudden crisis. Again, we see it with the BlackRock Real Estate Fund. We see it with many funds that are publicly traded. They trade at a discount. Either you accept that or you don't, but that's it. You may be disappointed that you are facing such a discount. That's life. You've lost money on your investment. That's how it is. Economists should never make any predictions, mostly because they are wrong, but I did venture to make one recently. I'm writing a full paper on that, which is that I believe that the industry will will face a large amount of lawsuits at one point in time. And that is what will trigger regulation intervention by the SEC, the FCA, etc. But unless somehow the UK would decide on the government side to intervene and to beforehand, that would be my prediction. And so what I foresee is that I don't know when it will happen, but at one point these people who are, let's take one example. People right now who are doing, retail investors, put money into a semi-liquid vehicle that is doing private credit. So you can put your money into a vehicle that does lending to companies, private credit. When you sign, you may not realize, but there is one condition that says you cannot sue me for the wrong NAV. So I'm going to give you a valuation. Correct or not, you're withdrawing your right to sue me for this. Okay? So right now it's going through. It's fine. At one point, somebody will go to court and say, I'm not sure you're allowed to prevent me from suing on lying to me. Okay? And there is some laws that are above that. So you will see a series of lawsuits on valuation, especially with the semi-liquid funds. You will see a series of lawsuits on hidden fees, on all kinds of things that people were not informed of. And that at one point the SEC and the FCA says, yeah, we may be needing like a lot of investor protections in that space because we're protecting them a lot on public markets where things are fairly transparent. And here we tell them it's open bar, it's whatever. Like it's adults consenting adults, so we're not touching anything. And so unless you want to front run this as a parliament or as a government saying, we're not going to wait for the lawsuits and then having a reactive regulation, we are going to anticipate that and ask, a bit like the Dutch did with their central bank, to have stricter rules around valuations and the like, but it's with a mindset of investor protection. And maybe at the same time you will avoid a bit of a bigger financial crisis, but that, again, I don't see a freezing of the economy because the valuations are wrong.
Thank you. Sorry.
I just wanted to very briefly add on the lawsuit part of the story. I mean, there's a lot of discussion about what's happening and why we're not seeing big funds, in the courts and sort of litigation in this area. It will come at some point, but I think the lawyers that are advising on these types of deals are very sort of carefully helping their clients to navigate through these waters, and things that we will see litigated and the lawsuits, those issues will not, there will be maybe on valuations, but as far as I'm aware, the valuations are something that are sort of, settled behind the scenes. Those will be more issues such as a fund, employing a very aggressive strategy and being, alleged to be a shadow director in a company and, destroying, for example, the company. This is something that we will see at some point, even very sophisticated Wall Street funds, because, these trends come from the US. They're not aware of how our legal sort of system works, and there are actually quite big differences when it comes to that side of the story, how the US and UK work. And I'm aware of cases where actually there was a settlement, it didn't go to court, the fund was alleged to be a shadow director with huge implications. This is really big, but I don't expect this to be. I don't expect this to be like a big wave of lawsuits, because they're sophisticated investors and they have very good teams of people advising them. But I agree with you. It's not so much on the regulatory sort of side, but more on the sort of them being involved in the companies and what they're doing both positively and negatively for the companies. So.
Just on the valuation thing, obviously we're talking about here mostly private assets, which are ultimately valuation is a subjective question around those. There are methodologies and whatever you can apply, but it's quite subjective. As a result, you tend to see valuations moving upwards quite quickly and downwards quite slowly when there are reasons to move valuations. I suppose the question is, does the fee structure of these funds tend to push them that way, the old traditional 2% on assets under management plus 20 over 8 or whatever it might be? Is that an incentive for the funds to overvalue effectively and to hold values at a higher level than they should be?
So one characteristic of private market fee structures is that they are not based on NAV because nobody really believes them. And so if you were basing them on NAV, you would have so much discretion on your own pay that nobody would really accept that contract. So the fees are based on when you exit, we count the cash and then we share. For
the 20 over 8 thing.
Exactly.
Yeah.
And then the management fees tend to be on how much capital you have committed to me, or how much is still on the ground of what you gave me, but not based on NAV. But there is a very recent trend where we have seen, especially with retail investors, fees based on NAV. Mm-hmm. And that, again, is because retail investors don't understand that it's absolutely impossible to set, it's unacceptable to set a fee on NAV. But for a retail guy wouldn't know that. No institutional would accept that, but retailers don't know. So this is another good example of needing investor protection even more badly now that retail people are in, compared to before. I think there was still need of protections before for institutionals, but now with retail, it's amazing. And this is a very good example where somebody sets up their own pay, basically, and retail just pay. And eventually this will lead to lawsuits.
Or it will.
Oh, right. There's two issues that I'd like to address, but I just also want to comment on the jaw-dropping sentence in Professor Phalippou's paper, where he says highly leveraged care homes experience double the death rate compared to those with lower leverage. Gosh, that's a systemic risk, death.
So then we need to define systemic risk. Yeah, I mean it's a dramatic risk, but yeah.
But still, there's two things I seriously wanted to ask. First of all, for Dr. Favarian, you quite rightly said in the mixture of finance, which you call chameleon, that this becomes highly relevant at bankruptcy, because then the distance between equity and debt. So. But you seem to leave out the fact that it's highly relevant for taxation. And, for example, as we know, when you have differential taxation, the Modigliani-Miller theorem doesn't apply. So I was puzzled about that and wondering to the extent to which fiscal aspects, which are, after all, governmental, as is regulation, but fiscal aspects are driving part of the development of private markets as you discuss them. So that's the question for you. And then I've got a question for...
thanks very much. I completely agree with you that this sort of the phenomenon that I call chameleon capital, it covers various areas, including tax and accounting. I'm not a tax law expert. I don't want to say anything about tax law. I'm sure that there are sort of people who are qualified to talk about tax law much more than I do. My main concern, and I agree with you that this is a big issue, but my main concern is, if we look at this from a sort of bankruptcy and also corporate law perspective, we have a very isolated sort of treatment of equity and debt. And what happens if you have an investor?
I understand that. The reason we're concerned as a committee is, of course, that the general argument that of a lack of equity investment in the UK compared to relying on debt because of the favourable fiscal.
Right. It's something that we should definitely look into, and I have a separate paper that looks at chameleon capital in distress, looking at the bankruptcy implications of this. But I do wonder whether we should think about this more carefully, because it opens up lots of new questions about how we look at equity and debt within context of very important questions such as investor accountability and investor protection, directors' duties and controlling investor duty. We don't really have a regime for, it's something, there are rules for equity, there are rules for debt. There are very little rules that corporate law provides to protect actually creditors. Most of it is an insolvency. But what if we have someone who's an investor who is either a peril investor or is an investor who's today an equity investor and tomorrow is a debt investor, or the other way around? And I think in this way they're influencing the company in various positions, and the law doesn't really provide an adequate response to this.
Okay, thank you. Right, now, there's been several times this morning, people have mentioned relational lending. There's a relationship in some sense. And one of the sort of caricature of modern banking is that relational lending has disappeared. You lend on the basis of an algorithm. You've got no idea who your bank manager is. There's this image of the little town bank manager who used to hold your hand, so to speak, and business things. Whether that's true or not, I don't know, but there's certainly the idea that this has disappeared. And I was just wondering, there is famously, Handelsbanken, which is becoming quite a successful institution as a banking institution in the UK, does pursue relationship lending. It's mostly to high net worth, but it's relationship lending. It's a sort of private bank for the masses, Handelsbanken. I don't know if the banks move back to that sort of model, would they recapture a lending market from the private?
That's a question on strategy for private banking, because there's very much, and so my wife is a private banker, so I can tell you. It might work, but that's the entire business model of private banks, that you build this relationship. If somebody needs whatever advice, they can call you anytime, etc. But it's true that it's not profitable for people below a certain amount of income. Revolut has a project of doing this sort of private banking for the masses, and maybe they will succeed, but I don't know if they the odds of succeeding.
For example, if you have an account with them, you also have the mobile phone number of your manager.
Yeah, so which is quite amazing that nowadays we think of that as a miracle, while it used to be that indeed the bank manager would know your parents and everything. So yeah, maybe that will save them. It's possible, but I don't know whether that. But for business lending, we're talking about relatively large sums of money, and you have the sorts of relationship we are talking about is more. Aries would go to Air France and say, look, I will always be there for you. We sign a deal here, and if you need more money within 2 years, I will give you. I'm credible because I have all this capital that is committed to me, so there is no problem with me lending more to you if you satisfy these following criteria. So that's the sort of what has become the relationship lending. A quick remark on when you say we want more equity and not debt, and like, again, I think it's very important to distinguish between primary and secondary market. Somebody coming to the UK, even if they buy Manchester United with only equity, that's not helpful. They're just buying out the previous owner. Whether they use only equity or whether they're using a mix of debt or equity, it doesn't change anything.
It's entirely
what makes a difference is if it's a primary transaction. So somebody comes in and like the Qataris in Paris, and then they say, look, here is several billion.
Okay, thank you very much.
Lord Smith.
Talking about systemic risk earlier, and you were both downplaying the chances of that. Now, I go back only a few years. I'm not talking about 17 years ago, and some words were said in political circles, and bond market yields went up and values came down, and a number of pension funds suddenly were discovering they're very big on bonds, like they might be big in private equity and things as well, especially ones in Scandinavia. But suddenly we discovered that, and that had a major effect. Bank of England had to step in and put up very, very big money. That was a systemic risk. Now, it went away. It wasn't like 2007, 8, 2008, 9. But, can I just put it to you, there is a risk there somewhere, and if a lot of these pension funds are in these other areas now, part equity, part fixed debt in quite high leverage vehicles and so on. And also here we seem to be moving to an absolute free banking market from what you're saying, because if we loosened up a bit in banks, they wouldn't have all these compliance people, so they'd be able to lend again. Can you just repeat what you were saying? Because I just heard about, ease regulation, existing regulated people don't regulate any more than we need to on these new vehicles. I'm just saying, I think there's still a systemic risk there somewhere.
If I could just supplement that, one image we've had around exactly the issue Lord Smith is talking about is that risk is like a balloon, and you've squeezed a bit of the balloon in the banking bit, but the risk is just the balloon has grown up elsewhere.
My position on this is I think we don't know enough about this market to be able to say that we need to regulate it. And that's why my suggestion is to better understand the interconnectedness that I'm mentioning between not just the markets, but also investors and capital. I think this is really important. And interconnectedness not just between the UK, banking sector and private markets, but actually the global interconnectedness, because there's a lot of traffic between US and UK across Atlantic. So at this stage, my answer would be that we just don't know enough about this market. There isn't a lot of comprehensive empirical data that will show that there is systemic risk. I completely agree with you about the point that one might argue and say that, you know, you squeeze the balloon and you sort of you give it to the sort of the other players in the market, but we don't have enough empirical data to be able to credibly say that there is systemic risk. But we are starting to get more data, empirical data, that shows the interconnectedness, the exposure between the markets, the investors, and capital. I keep repeating myself, but I think it's important not just to look at this one circle of interconnectedness, which is between markets and between the markets, but also between investors and capital.
So the pension funds in the UK have something like 3-4% of their assets in private equity and private debt. It's not a large amount of money, not like bonds, which is about half or 40%. So when there was this big problem in the bond market, we were talking about very large sums of money for the pension funds. And then it's down to the government to decide whether they want to bail out the pensioners or not. But that it didn't freeze the economy, even if the government had said, well, too bad you lost your pension. You know, it could have been a scandal, but not. But it's important to bear in mind that the pension funds have very little on, and probably USS is one of the largest amount of private markets, and it's probably 30% or 25%. So it's not large amounts of money, and the odds that it would go exactly to zero is also pretty extreme. Unlike like when what happens in the bond market was meaningful amounts of money. Here, like the chances that there will be a meaningful loss is low. I repeat, however, that in insurances it's different. So insurance companies have been piling up on private credit, have been levering up positions on private credit. What we haven't mentioned so far is that private credit funds often borrow themselves in order to lend. So they are leveraged after layers of leverage, and insurance companies are sitting on top of a lot of layers. And so what could happen is that imagine that you would have a natural disaster in the UK, people go to their insurance companies, the insurance companies cannot service the claims because they have piled up on these private credit funds and the valuations were wrong and they cannot withdraw, the liquidity is not what they anticipated, they had all these layers of debt, etc. And then the UK government then has to step in and say, sorry, you did have an insurance claim, I think it's important that we pay, so we pay instead of the insurance company. So that could be a major concern. That's why insurance companies have these capital requirements, where we usually there is a strong regulator to make sure they can pay what they promise. With private credits, a number of insurance companies are in a situation where it's not clear at all that can pay what they have promised. So that may be worth thinking about rather than the pension fund or the bank situation. Then about the idea that the risk is going somewhere, yes, the more debt there is in a system, there is a book by a Harvard prof that has actually linked every financial crisis to a debt overhang. There is too much debt at one point in time, and there is financial crisis. There is, put differently, there is never a financial crisis that occurred without a massive, unprecedented amount of debt that has been built into the system. So we have extraordinary amounts of debt. If you go to any business and you work out all the different structures of leverage on top of that business, it's a massive amount of debt. And there has been a massive increase in interest rate that should have been enough to collapse everything, but it didn't, probably because these private credit funds are quite flexible, they can pretend, they don't need to mark to market, etc. So the question of the fragility of the economy is a legitimate question. But then we are talking about how do we limit the amount of leverage that any business takes on. So to go back to the care home paper that I wrote, during the first wave of the COVID, before anybody got any governmental help, there was twice as many deaths per resident in on care homes. But what the paper shows is that also some care homes were not held by private equity, were equally highly levered, and they had twice as many deaths as well. So if you would have just looked at ownership, you would say, look at these evil private equity people, they really have all these deaths on their hands. But if you look at it, really it's leverage. yes, all private equity put leverage, but there are also non-private equity people who put leverage. So then if you're interested in that question, which I think is an important one indeed, then think about how to limit leverage in an economy. How do you limit the deductibility of interest payments and so on and so forth? It's not trivial at all. You probably need international cooperation. The definition of leverage is not that easy to define, etc. There is a law in Europe, which I think is also the case in the UK, that no company can lever more than 6 times EBITDA, but there is no law on exactly defining EBITDA, so you can define it the way you want and then you can get the leverage you want. So it's not easy to implement, but that could be a noble pursuit, and then you'd have to think hard about how do I de-risk the economy in general by not encouraging at least people to pile up on that.
Could I just very briefly add also that the reason why many funds are going for this chameleon capital, they create equity which looks a lot like debt. It's exactly for those reasons, because they don't want to show debt on their balance sheet. Yeah. So that's why they create chameleon capital. Mm-hmm.
Lord Kestenbaum, Lord, just before I call Lord Hill, almost 4 years ago, in another committee, which I was chairing, the Economic Affairs Committee, we published a report on quantitative easing, which we described as a dangerous addiction. Am I wrong to conclude that the impact of quantitative easing has in part been responsible for this huge growth, because of course it held down interest rates, and we now have the problem of how to resolve the short-term high interest rates which the government are paying and everything else. And I just wonder if you just say something about the impact of quantitative easing in creating this growth.
I was always a very big critic of quantitative easing, so I'm glad you tried as well to stop that. I think it was a drama. It created the first impact that created massive wealth inequalities by allowing whoever had assets to borrow at 0% and to release capital this way, etc.
I interrupt you, but it is also relevant to the whole issue of valuations.
So these valuations were inflated, and people were able to cash out on these inflated valuations by borrowing if they could. So it was only people with assets, and then the people who had rotten assets could even have the central banks buying their rotten assets from them at a better price than the real market value, etc. So it was really a direct subsidy to the wealthiest people, the asset owners. And so I think it was quite dramatic, I think, for society in general. But on the private markets, there is it's a thesis that has been pushed by two researchers at Harvard called Ivashina and Lerner, that quantitative easing is a primary responsible for the growth in private market funds, private equity and private credit especially, because there was this perception that everything is zero, the bond market will give you zero, so you will not make any money with a bond market. Some have the same perception with public equity, and then people turn to like private markets because they thought they were the only ones who could give any sort of decent returns, and therefore we should put their money there. We saw many pension funds in different countries reasoning that way, sovereign wealth funds as well, saying, we need a decent rate of return on our sovereign wealth funds or pension funds. The only way that could happen is with private markets. So there was this belief that was built in, that was accelerated by quantitative easing, because it was in your face that you would have zero or even negative interest rate if you were leaving it in bonds. And so the money had to leave the bond market and go to something like alternatives. So there is a good evidence to think that a lot of the capital flows into private markets were triggered by quantitative easing. It grew already in the 2000s before quantitative easing. There was a fair growth. It went from about 1 trillion to 6 trillion in 2007. So private markets have grown without quantitative easing. Venture capital grew in the 90s without it. But post-2010, we did see a number of institutions shifting, and whenever they were justifying it, often bringing that argument that the only way for them to hope for return was private markets, and especially on fixed income like insurance companies. I'm an insurance company. I'm asked to hold a lot of fixed income. It's zero or negative interest rate. There is no way I can survive with this. My only hope is to put it in a private credit funds that deliver 10%, which may be fake debt because a lot of it is equity in disguise and highly levered, etc. But the regulator let me get away with it, so I'm just going to pile up like mad on private credit. again making it extremely risky situation for insurance companies. So quantitative easing has created a lot of drama on that front as well, yes.
Lord Hill.
Let's check that I've sort of understood the broad drift of what you're arguing, which is that these developments that you've described very eloquently are not of themselves increasing systemic risk, that there's no question discernible effect on the availability of capital into the system, particularly at the large end, and indeed some of these developments perhaps make that more efficient because the cost might be lower, the cost might be higher, but it's done more quickly and there's more availability. And that there's no immediate need to rush to regulation. I mean, you made the point about investor protection, that may be something one needs to look at, and there's a point about information. Is that a fair summary, really, of what you're arguing? So, in terms of the gap that the development that you described might leave, so you said, banks have been caught between pincers of what we spend a lot of time discussing, private markets and then Monzo Revolut. What do you think? Do you think there is likely to be a gap for the availability of capital for smaller businesses? And do you have any thoughts on how that might be filled?
I think the summary that you presented is my understanding of how we should approach this question. And on the small and sort of medium-sized companies and the gap, I do think that within these private markets, we're seeing sophisticated players that were already there before the global financial crisis and new players. And for some certain smaller companies that have no credit rating, those sophisticated market players, they're not necessarily interested in funding them. And so the question is whether the new players that come in now, because it's a booming market, are in a good position to provide this type of financing. They do this, but I do have certain concerns about how they do this, because within this universe of private markets, when we're talking about private credit, there's so many different types of private credit funds, and the hybrid funds that I was mentioning, they are the most sophisticated ones. So my worry is mostly about the new players who are funding the smaller companies, because the sort of the bigger players, they're no longer interested. The upper middle market has actually gone up. It's not 50 million now, it's much higher. And these sophisticated players like Ares, they are more interested in funding already, AT&T and Air France. So that's a concern that I agree with you. I think we need to think about this more carefully. And if there are any risks, I think the risks come from those new players who do not have enough expertise, unlike the bigger ones that have already been in the market for a longer time.
If small businesses, as was mentioned also earlier, have difficulties getting lending at the moment, which I'm not familiar with, but if they do, I don't think we can blame it on private credit. It's up to the banks to lend. Only if one had in mind, like, Lloyds was making so much money with private equity lending before, and out of the goodness of heart, they were using some of their profits to lend to small businesses for the fun of it, or for the benefits of our society. Maybe, but I have difficulties to believe that model. So I think that if banks are retreating from lending to small businesses, then we need to study again, compliance issues, onboarding of clients, and all these things.
There's one brief one about Europe and the EU. So at the very beginning, you had some stats that some of these trends are common, but Europe, which traditionally has been much more reliant on bank financing for its economy, how do you think these trends affect the ability of the European economy to fund itself?
I think it's a great question, and I think it's also relevant for us here in the UK, because if I think about it from a legal point of view, all these trends are coming from US, and the US investment funds are bringing their own, what I call legal trends and legal customs. And continental Europe is more affected than us, because the way that their legal framework is, whether it's regulatory, but especially because I'm an expert in corporate law, it's quite different. And they have more constraints in welcoming this type of financing. There are lots of innovative trends, including things like liability management exercises that these funds are doing. And that's much more difficult to do in continental Europe because of their legal system compared to UK, where we're a bit more flexible. So yes, I think, and that's the reason why also we see the statistics that I was giving in continental Europe, the market is much smaller because there's a bit more resistance, but the resistance is not necessarily because of regulation, but because their corporate system is actually quite different. Quite different. So
there's not much private credit outside. So like continental Europe doesn't have that much, and then we see some in Turkey in emerging markets as well. But the legal is difficult because they are very complex structure of this private credit fund, so they cannot easily, deploy in Eastern Europe or and banks are very present in Europe, so they in France, in the Netherlands, Benelux, etc. You still can go to a bank.
The legal systems in 27 countries are
that's the reason why when the US funds, they translate they ship their trends to the UK. London is actually the first global hub where these trends are being tested, redefined, and amended, and sometimes actually rejected. So London plays a very important role in all this sort of legal trends and whether we accept them or not. And from my point of view, actually, that's the bigger question. The things that I worry about a lot are the corporate legal trends that the funds are bringing from the US, which are not fit for our legal system. And I think London is doing a very good job, but there are lots of important questions that are unanswered, and we don't see litigation here very often until things go really, really wrong. So,
okay, thank you.
To go back to something you said at the very beginning, and in respect of, you described, I think, venture capital as the good guys, and a lot of what you've said since, which deals with my own experience as someone who's been through the entire private equity cycle as being owned by private equity. I'm on record, I think, as describing it as parasitical, frankly. I don't see that they add any value at all. Would it be true to say that because the returns you get from basically leveraging up, and that's really where it came from back in the late 90s and whatever, when pension funds couldn't leverage, but it was a way of getting leverage into pension funds, effectively, was the genesis of it. Is it fair to say that the sort of growth in private equity has perhaps driven the fact that venture capital is not in the same, is constrained? And how do we encourage the investment into primary growth rather than secondary and sort of financial engineering?
So I recommend a book that is called The Boulevard of Broken Dreams. Well, that's because I like the title.
Been there, done that, believe me.
It's written by George Lerner, who goes over all the initiatives in the world by governments who wanted to create more venture capital, etc. And the title can suggest the answer. It's always a bit tricky when you want to subsidize. The returns in venture capitals have been decent-ish. And yes, there are good players, usually welcome everywhere, but it's not easy to make money with this young early stage entrepreneurs, and it's a very difficult question. So I would be careful about this subsidy or to venture capital. If they have decent returns, they will have money. Whether LBOs have kind of hidden them, it's hard to test, but venture capital has grown quite a lot. Yeah. And so they were quiet in the 2000s because people were still traumatized from the 90s, so that took them 10 years to forget. It's usually what it takes in finance. And then venture capital did extremely well. The last 10, 15 years, they gathered really a lot of money. But right now, their valuations are not really believable, so we think they have less than what they say they do, but it's quite a lot of money on venture capital. And again, same thing as with private credit. Most of the money is in the US and in China, actually. So in venture capital, it's 50-50. China has as much venture capital and growth capital than the US has. And then the UK is tiny compared to that, and the rest of Europe is yet smaller. So it's not easy. The UK, because of Brexit, has been out of EIF in Luxembourg, but that was a big hub for venture capital investments. That was a conduit for stimulating the EIF invest only in venture capital funds in Europe, etc. So was providing a lot of capital for growth and venture and lots of advice and helping, playing quite a big role. But the UK has gone out of the EIF, and that actually we have some direct evidence that has hurt quite a bit the UK venture capital industry.
Ernestone?
I'm still reeling from the phrase that it's not clear what the distinction is between investment and debt. As an individual, if I didn't have that distinction, I could lose my house, presumably. So this is the hybrid funds that you were talking about earlier.
Hybrid capital and hybrid funds.
But the implications of that, of there being confusion in what seemed to me to be two opposite things, surely, going back to Lord Kestenbaum's question, the risks inherent in that must be great. Now, you've both made some very useful suggestions. Firstly, that we should make a more standardised information system, so we have better information about things like valuation. You've suggested certain possible reforms in corporate law. We've had later the issue of limiting leverage, how we would do that. I'm not quite sure as a committee, because it is what the committee is about, is to make recommendations about improving a system. And then you also referred, I think, to insurance company debt as being another area that could be looked at. It seems to me there's quite a limit in what we as a committee can do to extract or make recommendations about some of those areas. Would you have any other... I mean, some of those political, particularly on the tax, which I think was one of the questions that was asked, is that the difference, the taxation system? So I haven't yet got a clear idea of what we could do to make a difference. And can we learn from anywhere else, any other jurisdictions? It doesn't seem to me to be that clear that we can learn anything.
If I may go first, I think on the corporate legal reforms potentially, that's the reason why I started my research looking at corporate law, because I think it should provide the first answer before we look into insolvency law and tax law. And I'm aware also of discussions about potential reforms for Section 172 of Companies Act on directors' duties. So I do think that we could potentially integrate these chameleon capital issues into that discussion on how we treat equity and debt in corporate law, and the questions on investor accountability and investor protection. Equity and debt, very disintegrated, isolated, approach in our legal system, and things are really blurring. And in the US as well, they are bringing this legal trend. So I think that would be my first humble sort of suggestion to take a look. What we can learn from...
Is there a reference anywhere there that we can use, that statement that you just made?
Well, my paper, Chameleon Capital paper, in that paper I discussed this evolution post-global financial crisis significantly and the post-COVID, and explain what are the open-ended legal questions, both for equity and debt, and how we could potentially make reforms to directors' duties, but also introduce new notions on controlling shareholder or controlling debt holder, because if they do things wrong, that's hugely problematic. And to my knowledge, the only legal mechanism that we have in our company law in UK that has an adequate response to what I coin as chameleon capital, it's Section 251 of UK Companies Act on shadow directorship. And the reason for this is because shadow directorship, if you're a shadow director, you're held accountable. But the definition of who's a shadow director, it's a person. It doesn't really matter whether you're an equity holder or debt holder. As long as you're in control of the company, as long as you interfere and do something wrong, you're going to be held accountable. And I think that this should really drive the story here about chameleon capital, because it could be used for opportunistic behavior. On the question about...
Can we use that extract from your paper?
Absolutely, absolutely. It's last section, implications of chameleon capital, there are many implications, but I had to sort of narrow down the scope of the paper. But the biggest argument of that paper is it's about control. It doesn't really matter whether you're an equity holder or debt holder. Many of these credit investors are actually running the company, and they're heavily involved in corporate governance and with positive and negative implications. But our legal regime doesn't really think about creditors in that way from a corporate law point of view. When it's insolvency, yes, insolvency law comes in, but things happen before nowadays, so we might want to think about this in more detail. On the question about what we can learn from US and EU, not that much. I think what I would suggest, and is the biggest worry for me is, as a lawyer, these legal trends are coming from US, as I mentioned. There are legal trends or legal customs. They're being shipped from New York, and London being the first hub where we're testing these things. But we're also explaining certain European constraints to our American counterparties. And in a way, US funds are rewriting the global law of debt. I have a new working paper with my colleague from Harvard Law School, Jared Elias, and we're looking specifically at this question, how the US private credit funds, private equity firms, venture capital, they bring in their own ideas, and some of those work really well for us, but some of others, they don't really work for us, whether it's for our corporate law, insolvency law, tax law, or other things. So from my point of view, the question is more on the legal side and less on the sort of how do we need to regulate the funds. I'm not saying we shouldn't, but I think it's too early to be able to comprehensively say how we should regulate them.
Yeah, so I'm sorry, like as academics, I can explain to you why everything is very complex and being pretty hopeless at telling you what to do. But I'm happy, I have written notes on the questions that were asked, and I'm happy to send them into other section on possible policy implications. To give you an idea about how complex things are, we talked about limitation of leverage and things like that. So the more you borrow, the higher the interest you will pay on the debt, right? So if you would load up a company in 90% debt, you pay probably 15% interest rate. So HMRC, for example, has a rule that says if you show me a debt that is at more than 8% interest, you can call it whatever you want. I don't call it debt. So the interest will not be tax deductible, right? So given the discussion, I say very good. So the UK does the right thing. Above 8% of interest, it's not tax deductible. That discourage high debt. All you need to do is that you make a shareholder in that corporate structure that is located in Luxembourg, and Luxembourg accepts up to 15% that you deduct your interest on that because they will consider it like that. So all you need to have is that the shareholder at that stage in your corporate structure is located in Luxembourg, or it can be located in Jersey because they probably will have something similar. So it's extremely hard as one country without extreme coordination with others to implement anything that would make a big difference. And so that's the difficulty. And everybody is there, so there is no one you can really learn from because everybody is facing that kind of issues. So I would only encourage strong cooperation, and I'm happy to add the paragraph on possible implications for you, but the power of one nation is limited even with the best will because it's a big coordination issue.
On that note, I think we can conclude the evidence session.